but I'd like to start just with an acknowledgement and thanks. You know, the financial year of FY21 was a really difficult year for all of us, with the governmental response to the COVID-19 pandemic, including restrictions on work and travel and schooling, on business operations and social interactions. And it presented circumstances that most of us in our professional and business lives probably never imagined possible. And within both our B2C and our B2B operations, our advisors across the group certainly weren't immune to the challenges themselves. And I'd just like to acknowledge that, you know, the intimacy of the relationship between financial advisors and their clients is something that's too often overlooked. And I know that the advisors in our group have shouldered a great burden on behalf of their clients as they've helped them face those challenges across this period of time. And having observed this firsthand and at really close range, on behalf of the directors and the shareholders of WTL, I'd just like to take the opportunity to thank all of the advisors in the group and their many great support staff and their families who support them for having so steadfastly continued to help so many Australians, their families and their businesses navigate an uncertain time that's been thrust upon all of us. So I think they can all really hold their head high, having steeled their resolve, not only face their own challenges as we all have, but also continued to support what is literally tens of thousands of wholesale and retail clients across our group through this most challenging times in history. And I'd say a special thanks also to our long-standing shareholders who've supported the board and the management team as we've executed our transformational restructuring program from really being a complete B2C business with our focus on Spring Financial Group operations to now being primarily a B2B focused business, spearheaded by our acquisition of Wealth Today in 2018. Look, in large part, these last 3.5 years of our restructuring has meant really short-term financial outcomes have had to take a back seat to more strategic long-range thinking to ensure that we recapture long-term value in the company's IP and assets. Adopting this approach, however, has seen us emerge as a disruptor, really, in the wake of the Royal Commission, rather than ourselves being disrupted by the incredible structural shifts that the financial sector has seen as the profession modernises. You know, against this backdrop, it was really therefore very encouraging that we got so much support from our existing shareholder base, but we're also able to welcome so many new institutional and direct shareholders onto our share register over the past 12 or 18 months, including those who so confidently backed our placement of new shares to support our acquisition of Century Group. You know, that the placement that we did was oversubscribed by 25% at a 25% premium to the last traded price at the time. And I think that really underscored the market confidence in our transaction, in acquiring Century, in the company and management team, and also in the sector more generally. So in terms of results for the year, you know, despite the impact of the pandemic really tempering our momentum, we've managed to continue to grow revenue across the year, with it being up some 6% to 13.5 million. Significantly, our B2B revenue was up 24% to 10.45 million, and our recurring and repeat revenue closed the year representing around 86% of our revenue, which is really what the key focus has been over the last couple of years. So as restructuring continued, the operating profit was in line with the guidance we'd given earlier in the year, being marginally positive, with an EBITDA of a modest $36,000. As we previously detailed in announcements and market guidance, we took significant steps at the end of the year to restructure the company's balance sheet to make sure that we had a clear runway for FY 2022. So after accounting for a series of one-off write-downs and provisions totaling nearly $3 million, the NPAT result was a loss of $3.28 million for the year. Most significantly, at the tail end of the financial year, as we signed an agreement to acquire our industry peer, Century Group. And we settled that transaction in July, and that has seen us emerge now with a very significant 275 odd advisors across 200 plus advice practices spread fairly evenly across Australia. And so we've really emerged now as one of the largest and fastest growing independent or non-aligned, non-product producing financial advisor groups in the country. And the Sentry acquisition was really highly complementary and transformational for us. It's brought great scale and efficiencies. It's delivered an expanded board thanks to the addition of Michael Harrison, who Guy's introduced today, and I'll talk some little bit about more about Michael and his experience later on when we come to the resolution for his re-election. We've also expanded our management team with the addition of David Newman, who continues as the MD of the Sentry business and has joined our Chief Operating Officer, Frank Paul, as a joint COO. So with the Sentry acquisition now completed, our revenue guidance for FY 2022 is again for a very significant increase over last year to around $70 million for the year. And as we've provided guidance, we're expecting a net profit in excess of $2 million for the year. So look, having had a strong dividend history of paying out nearly $7 million in dividends since our inception, I can assure you that the directors are all motivated to see a return to dividends at least annually. And we're looking forward to being able to do that at the conclusion of the, recommence those dividends after the conclusion of the FY 2022 year. You can be certain that you've got a very engaged board and management team, very strong shareholding with all of the board members, executive and non-executive, having shareholdings in the company and very significant ones at that, and that extends to the management team in the business as well. I think the board collectively has more than 25% of the company. When you extend that out to board and management, you're starting to push up close to 40% of the company. So you've got a really engaged team involved with you as shareholders and with really close alignment as to what we're all trying to achieve. So in terms of what's happened since the end of the year, as we settled the Sentry acquisition in mid-July, as I say, and look, despite the lockdowns having presented some challenges in terms of getting around and dealing with the advisors and integrating the staff, as I'm really pleased with how that integration process has gone. As I think it's fair to say that the execution risk on the integration of the operations has been met, and we're out the other side of that. The executive and operational teams have dealt with it very well. Of course, we've been having the discussions with Sentry for many months leading up to the settlement, and so that really positioned us well to be able to hit the ground running in terms of executing on the strategic plan that we'd all set out, and deal with those key operational matters. So look, the acquisition's a highly complementary and transformational one for us. It's brought great scale, and we're very enthusiastic about the future ahead. We expect to be able to provide continued growth across both organic opportunities. The landscape for advisors is becoming increasingly complex. The type of advice being demanded by consumers because of the complexity of superannuation legislation and the investment landscape and risk management landscape, the way that it's changing so much, has led to advisors really needing to upskill significantly. And the demands on them from a regulatory perspective across education and compliance are increasing. So what advisors are looking for is a dealer group that really understands the space that they're in. And what WTL brings to the table in this regard is that, we build our entire business on dealing directly with consumers. So the management team and the operators inside our business are all very familiar with what it's like to be sitting in the room with clients, to be building a practice, running a practice, and dealing with the challenges that presents every day. So it's this sort of pragmatic and very commercial approach that we bring to supporting advisors that's setting us apart. On this basis, we really believe we can look forward to considerable further organic growth. Advisors are still on the march, looking for someone to support their requirements in terms of upskilling and supporting them in that commercially pragmatic way. So We are looking forward to strong organic growth. There is, of course, definitely transactional opportunities in the market as well. And these are twofold, as there's many of the smaller players are becoming marginalised. I think if you're running a dealer group with, less than 100 advisors now, as it's getting increasingly challenging to generate margin within a business that's at that scale or less. And so, from a strategic perspective, we're targeting a dual-pronged approach as further acquisition opportunity, perhaps in that smaller sub-100 set, but also there's bound to be more rationalisation and consolidation across those of us that are emerging as the larger players across time as well. So, a challenging few years behind us. Our transformation, I think, complete. Sentry has really set the platform for us now to be of a scale to move to the next leg, both in terms of organic growth and also future transactions.